Welcome to The Long Game. I'm Nathan Carter. And just so you know, this voice is AI generated, but every word is written to give you real insight with clarity and care. Today's episode is about one of the most misunderstood ideas in investing. Price is what you pay, value is what you get. That line comes from Warren Buffett. You've probably heard it before, but most people only hear the words. They don't absorb the meaning. Let's take it apart. When we buy something, a stock, a house, a meal, a new phone, we see the price first. It's right there on the tag. It's the number flashing on your screen. But price is just what the seller is asking. It doesn't tell you how good the product is, or how long it will last, or how useful it will be in your life. That's value. And in investing, understanding the difference between price and value is everything. Because the market is full of prices. Every second, they move up and down. But value, that takes more effort to see. It's like standing at a farmer's market. Two apples in front of you. One is shiny, perfectly red, sitting in a sleek box with gold lettering. The other looks ordinary. No packaging, just a simple sticker. The first one costs $5. The second one costs $1. Which one is better? You don't know. Not until you taste them. Maybe the shiny one was picked early, sprayed to look good, but the cheap one? Maybe it was grown with care, ripe, sweet, crisp. If you judged just by price, you might have missed the better apple. In the stock market, this happens every day. Sometimes the market prices a company like it's the next big thing. Everyone wants in. The price skyrockets. But the value? It may be hollow. No profits, no edge, no real durability. Other times, a solid, quiet business is ignored. Its price drifts lower, but the value is still there. Steady earnings, loyal customers, long-term vision. And that right there is where opportunity lives. Let's talk about an example, one that Buffett himself bet big on. American Express. Back in the 1960s, Amex was hit by a scandal. There was a fraud involving one of its subsidiaries and some sketchy inventory deals. Investors panicked, the price stock dropped. But Buffett looked deeper. He saw that the core brand, the trust people had in American Express, wasn't damaged. People still used the cards, still believed in the service. So while others saw falling price, he saw lasting value. He bought heavily. That investment became one of his all-time greats, and the principle still applies. Let's go modern. Let's talk about Meta, the parent company of Facebook. In 2022, the stock fell hard. Billions were being poured into the metaverse. Investors were spooked, revenue slowed, doubts grew. But value investors asked a different question. What is this company really worth, not just today, but over the next decade? They looked at its massive user base, its dominance in social platforms, its advertising engine, the ability to adapt. Some held on, others bought more. And within a year, the stock rebounded. Again, price is what you pay. Value is what you get. But let's pause for a moment. How do you actually see value? It's not magic, it's mindset. You start by asking questions that go beyond the screen. What does this company do that others can't? Do customers come back again and again? Does it have pricing power? Can it grow without burning too much cash? And this one matters. Would I want to own the whole business, not just the stock? If the answer is yes, you might be looking at real value. But here's the twist. Value doesn't always show itself immediately. It takes patience. Sometimes you'll buy a great business and watch the price go nowhere for months, even years. The crowd moves on, the hype fades. But then, slowly, the world catches up. People notice. Earnings grow. Dividends come. The price rises. It's like planting a tree. You water it, protect it, and wait. You don't pull it out because it didn't sprout overnight. That's value investing. And that's the long game. Now, I want to be clear. Not every low price means a stock is a bargain. Sometimes a cheap price is cheap for a reason. A broken business, a fading brand, a mountain of debt. That's not value. That's a trap. So you have to do your homework. You have to separate temporary pain from permanent decline. A good question to ask is this business facing a storm or sinking for good? Great companies hit rough weather all the time. Apple was nearly bankrupt in the late 90s. Microsoft was declared dead money in the early 2010s. Netflix was laughed at for mailing DVDs. But strong businesses bounce back because the value is still alive inside. It's like a house with great bones. Maybe the paint is peeling, the yard is overgrown, but the foundation is solid. Give it care and time, and it becomes a treasure. Now let's flip it. What about high prices? Sometimes people chase stocks just because the price is rising. It's going up. It must be good. But remember, price rising doesn't always mean value rising. It might just be speculation. And when the music stops, the fall can be painful. So instead of chasing trends, train yourself to ask, what am I really buying here? A story or a substance? A dream or a durable business? Because in the end, markets may fluctuate, but value endures. So let's come back to that opening quote. Price is what you pay, value is what you get. Simple, powerful, and easy to forget in the noise. But if you can hold on to it, really live by it, you'll see investing differently. You won't panic when prices fall. You won't chase when prices rise. You'll focus on what truly matters. Because behind every stock ticker is a business. Behind every price is a story. And behind every great investor is patience. That's what the long game is all about. Thanks for listening, and until next time, keep seeking value and keep playing the long game.